Welcome to World Forex. This is the first video of episodes of From Zero to Pro series, designed to take you from knowing absolutely nothing about Forex to confidently analyzing, executing, and managing trades like a professional. Here you won't learn what to do, you'll understand why the markets move, how institutions think, and when to act with precision. All you need to do is show up, stay consistent, and give your focus. Let's build your foundation. So, we're going to be starting with the trading terms and what overall is Forex trading. So, Forex is a global market where currencies are bought. And in this global market, there are approximately around 7 trillion is being passed or is being traded daily. Okay. So, institutions move currencies to accumulate liquidity, not to gamble. Okay. So their currency pairs, the currency pairs are what are traded. Say Euro USD, GBP USD, AUD USD, USD JPY, USD CHF. Those are pairs. And in the pairs, we have one base and one a quote currency. So say Euro USD, Euro is the base currency, and the USD is the quote currency. So in pairs, there are major, minor, and exotic pairs. Major pairs are those that are traded a lot and mostly are the USD, something that has a USD cross pair. So example, Euro USD, GBP USD, USD JPY, USD CHF. It has a USD cross. Okay, and major pairs are traded because they have high liquidity and easier to fill large orders. As we say, we have the base currency and the quote currency. In a pair like Euro USD, Euro is the base currency, USD is the quote currency. Say Euro GBP, Euro base currency, GBP quote currency. Okay, what is a pip? A pip is the smallest movement a currency pair can make, usually the fourth decimal place. But you don't really need to know about the pips because when you have an account with TradingView, you'll actually see how a pip is. We have a measuring tool here. When you go to TradingView, create your account, there's this ruler at the side here. So this ruler is what we use to measure pips. That way, it tells you the amount of pips right here that are there. That is okay. Let's take another currency pair, for example, AUD. You take the measuring tool from this low to this high. How many pairs are those? How many pips are those? 17.6 pips. So you don't really need to disturb yourself about learning about the pips. So you have a tool that simply does this for you. So another place here to here, that is 9 pips. Simple. Lot size. Lot size refers to the amount you're trading. Say one standard lot size is 100,000 units. And every lot size has a pip value. So $1 lot size, the higher the lot size, the higher the pip value. Leverage lets you control larger positions with smaller capital. Example, a 1 to 100. For every $1, you control 100 in trades. So leverage can work in your favor or against your favor. Leverage actually makes you trade like you have more capital in your account. And well, the higher the lot size you use, the higher the loss and the higher the wins. So it can work either in your favor or against your favor. Then we have the bid and ask and spread. So big in trading, there are usually two lines. We have the bid, we have the ask. Okay. Say this is say here. Okay, we can't see the bid and ask, so let me extend this. 1 minute. Okay. If you can see, there are two lines here where price is moving. The higher one is the bid, the lower one is the ask. So the difference between the bid and the ask is now the spread. Okay. But take it as something like this. Say you have prices, the price is moving there. The upper line is the bid. This is the bid line, and this is the ask line. And the difference between the bid and the difference between the bid and the ask. Now this is what we refer to as the spread. So spread matters a lot when you're trading. And then we have our trading sessions. We have three main trading sessions: the Asian session, London session, and the New York session. These are marked by this. This is true. The Asian session is from 2 a.m. to 11 a.m. London session is from 10 a.m. to 7 p.m. and the New York session is from 3 p.m. to 12 a.m. So you also don't need to know about the Asian the sessions. You need to know the times, but when you go to TradingView and under the indicators tab at such sessions, you can just put sessions on chart or sessions by Lux algo. See, it already marks out the sessions for you. This is the Asian session, this is the London session, and the red one is the New York session. Where you see this was the cross between the London and New York. Here's where most amount of volume is traded. This is the London session. This is the cross between the London and the Asian session. This is the New York session. This is the cross between the New York and the London right there. And this is the London session. Okay, that's how you know the session that you are trading in. So the most volatile hours is the London and the New York overlap. When the London session and New York session overlap at the same time, the most amount of volatility that comes into the market. So that is all about the introduction to Forex, knowing the terms and what actually Forex is. So therefore, that's all for today. And in the next lecture, we are going to be starting on chart basics: what a candlestick is, what a breakout structure is, what an order block is, what liquidity is. So this was just the introduction part, and we are going to be starting on more technical side of trading in the next lesson. So happy trading.